Palisade Radio is preparing to release an in-depth report on the fundamentals of uranium, including our top 3 picks for 2019. Sign up today at palisaderadio.com to be the first to receive our exclusive report.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. We continue today with part 4 of our uranium series. Delighted to have back Marin Katusa, best-selling author, fund manager, and founder and editor of Katusa Research. Marin, welcome back to the program.
Oh, it's a pleasure, Colin.
I am not sure if you had a chance to listen to part 1 and 2 of the series, but we had a guest that you know well, Mike Alkin, came on the show, and he basically painted over an hour and a half for us the case for uranium, the bullish case. And he also pointed to why he didn't think the bullish case for uranium worked, looking back in retrospect for, call it 2013, 14, 15, but why he thinks it works now. I wanted to get you on, Marin, to talk about the flip side of this, which is going to be the bearish case for uranium. And maybe before we start jumping into that, you can explain why you decided to use a bearish lens when looking for an investment thesis to jump into.
Sure, Colin. I've been around the uranium game for over 15 years, so I'm one of the few people in North America that have been to all of the producing assets and all of the projects. And, I just want to warn everybody that in a euphoric market, and we're not there yet in uranium, but we're going to get there. So many of these projects, Colin, look back to when you were in high school, what your father experienced. And, we were talking about it earlier, how, over a decade ago, sitting at a table with your dad and Doug Casey and all these different guys, and how the market just got so different than even possibly imagined today. And when it gets there, you're going to have, the Johnny-come-latelys bring up old projects that were, recycled so many times. And, after traveling to over 100 countries and putting on body armor to go to projects and having French Foreign Legion service, one thing I kind of want just a quick takeaway is 90% of these projects will never, ever, ever, ever get into production. Now, that's not a bad thing. It's just they're not ready yet. And whether it's economics or the price or permitting or social aspects, there's so many different variables to consider. That said, you want to focus for uranium in the first leg where what I call the real easy money, what I call non-AK-47 countries. And I just think such an obvious target would be in the U.S. And I'm sure Mike talked about all of the, how much the U.S. consume versus how much they import. But because I'm so widely followed, I said, let's take this backwards. So many big funds try to short what I do. And why don't I just write a short report on uranium? No one knows the sector better than me. So let's go through every single producing nuclear reactor. And let's propose that every proposed and planned shutdown of the reactors to 2040, so the year 2040, actually gets shut down and winded down. But let's just say the worst case, how many reactors would shut down? Then I would say, at the same time, it's a mathematical equation, we have to include how many reactors will be built. But I'm not talking about proposed or planned for the built that are going to be built nuclear reactors, only the reactors that are currently under construction. To be under construction means you're financed and you're already permitted. Remember, those are the two keys. So I remember 15, 16 years ago, I wrote an article talking about what were the percentages of, the last cycle before that was in the 70s, what number of the proposed and planned reactors ever got built? 8%. So for every 100 reactors that were proposed, 8 actually got built. So that's why I'm not talking about any proposed or planned. They have to be under construction. So it's a very conservative metric, Colin. So, but on the shutdowns, I was very aggressive. So of the proposed and planned shutdowns in the past, how many get shut down? Roughly about 2/3. So what you want, even though I'm over being conservative, that means by 2040, almost 60% of the current total demand would be weaned off from the uranium pounds per year. So about 95 million pounds would be shut down. We're about 169, 170 a year today. That's how many are shut down. What about how many are included? So of the built under construction ones that will be in production by 2030, it works out that in a worst case scenario, call it 9% reduction in uranium consumption would happen. That if we shut down all of the proposed and planned and on time. But remember, governments haven't built up the scenario. So this is a worst case scenario. Do I think this is going to happen? No. But if you're going to write a short report, you're going to really juice these numbers. And this is the absolute worst you can make it without being fraudulent on the numbers. I'm being very fair on both sides. And that's what the numbers say. So how do you play it now moving forward? Do you want to go for, leverage where uranium goes to $80 to $100 and have some moose pasture in Africa that has no infrastructure and no ports, no actual mining code for uranium? Believe it or not, Colin, I've been to projects that the government of the region had no rules for mining uranium, even though there was some uranium there. So shareholders have to be very, very careful where they're going. So for my thesis, for my money, I want to focus on non-AK-47 nations. And I think the easiest way to do this, regardless of a bear market, a decent market, or a bull market, the greatest way to get exposure or leverage isn't actually the pounds in the ground strategy. Now, look, everyone knows the big score I made on Northern Dynasty, and that's the ultimate pounds in the ground for copper and ounces in the ground for gold when it comes to undeveloped and a world-class asset. But here's something that, Colin, I'm sure you know, and hopefully your viewers will take away with this. The biggest leverage you get is actually royalty companies. Now let me talk about why. The metrics, how fund managers and the money movement, never before in the past has so much money been managed by so few people. People are talking about ETFs and all this passive funds. Look at the actual the uranium ETF. It has companies like Rio Tinto in there. The uranium sales in Rio Tinto don't even show up in their presentations, but yet they're in the ETF because these passive money is going in. But yet, when you talk about NAV, net asset value, or your NPVs, your net present values, you see so many of these incredible uranium deposits trading at a discount to their net asset value. So how does it go? You look at many of the producers are trading less than their NAV because we're in a bear market. The market's not giving fair value. The developers sometimes trade as low as 0.2, 0.3 NAV, so 20% of their NAV. But yet, historically, you look at the royalty and streaming companies, they trade at a premium to their NAV. And let's talk about why. Well, they don't take any of the permitting risk. They don't take any of the production risk. They don't take any of the development risk. They've taken out the risk from the exploration to the production and everything in between. And if you look at all of the, in the last 4 or 5 years, the royalty companies have completely outperformed any of the producers in the gold or silver space. It's just, you can't compete. And what's interesting about this is because of the performance metrics in the precious metal sector, over 50% of all gold mines in the world that produce over 100,000 ounces, and don't quote me, I published this number, but I think it's over 670 projects globally produce over 100,000 ounces a year. Might be 680, somewhere around there, just under 700. Half of them have royalties. Almost all of them have some sort of NSR, like a net smelter royalty. And then you have pre-production or a stream on them. So almost all of them have some sort of NSR, royalty, or stream on them. Yet, when I went through all the data in the uranium sector, less than 8%, or let's even be conservative, less than 10% of the assets in production have some form of NSR or royalty or stream on it. So, being a Canadian, we always love using Wayne Gretzky, the greatest Canadian hockey player of all times. Go where the puck is going to be, not where it is. And, I've been involved in building some producers, like Canada's third largest copper company. I've been on the board of that for 13 years. And you would not believe how much private equity money is trying to get exposure to streams and some sort of royalty, not just the public companies. For every public company in the precious metal royalty and streaming company, there's 4 or 5 private guys that you don't even know about. And because they're not public, but yet they have more capital available because they've seen the success in the streaming company. But yet, because uranium was so unloved, it's so misunderstood, it's so difficult to build a uranium mine. Colin, I can't emphasize to your listeners the difficulty of putting a uranium mine into production over any other commodity is a factor of 10, because people are misinformed. They believe, like, there's pictures of me holding yellow cake, and even family members and people in my office were like, man, aren't you scared to do that? I'm like, why? People don't understand the science of it, but what do they understand? They understand that Homer Simpson works at a nuclear plant, and look, a meltdown is about to happen in every episode whenever Homer's around. They have the China syndrome, the movie, and about the greed and the evil in the nuclear sector. There's so much misinformation. They know Chernobyl and what the media presents about that. And nobody wants this. I'm in the West Coast in Canada. The government of Canada, the provincial government of BC, banned uranium mining, and they actually paid a company to stop doing it. Totally misinformed, but it is what it is. So where my money, and I'm one of the largest funds in the sector, Colin, is saying, okay, if I take a worst case scenario for nuclear, how do I want to be positioned? I've been in multiple uranium cycles, and yes, there will be a time and place for the punters, I call them, who are looking for the pounds in the ground in Africa with nowhere near infrastructure and political risk, and they need $80 uranium. But I want exposure to cash flow, because when the big money comes in the sector, that's what they're going to want. They're going to want de-risked assets and politically stable jurisdictions producing cash flow, free cash flow, and dividends. So that's kind of the thesis that I had moving forward. And you look at, where can you go? Well, okay, you got the Athabasca Basin in Canada, and there's only a very few groups, and you have to focus on the people. Colin, you've been doing this long enough to find that there's a Pareto's law in the mining sector. There's something interesting about certain groups of people who are able to have success after success. And there's maybe 4 or 5 groups that you need to pay attention to in the Athabasca Basin. That's in Saskatchewan and Canada. That's where the highest grade mines in the world. And for your viewers, the biggest producer is Cameco, but there's other groups. You got the Lundins like Denison there. You've got Jordan Trimble, who I think is a rising star with Sky Harbor. Obviously, you have NextGen, which is a very interesting project. But they're on the other side of the basin. So the question is will they be able to build a plant? And then you also have fission. Building a uranium mill is even more difficult than building a uranium mine. So these are the questions you have to ask yourself when you're looking at the Athabasca Basin. Now, in the U.S., I think is the lowest hanging fruit, and I'm sure Mike will agree with me, because for the last 15 years in the resource sector, it was develop assets that China wants to buy, right? The commodities, like China consumes half the copper in the world, half the coal in the world, half the steel in the world. But yet people forget that the United States of America is the largest consumer of uranium in the world, and yet produce less than 10% of what they consume. Almost half comes from the former Soviet Union between Russia and Kazakhstan and Uzbekistan. And you look at that and you shake your head. America is very vulnerable, and they've been kind of bleeding themselves to death by selling the Department of Energy stockpiles at a price lower than what the producers can produce at. And in the U.S., like, I've been to all the projects, you want to stick to ISR. It's just a lower cost form of production. And within the ISR, you got between Wyoming and Texas. Texas is a lower cost. Why? Well, it's not as deep as the assets in Wyoming. And secondly, when you go to these header houses, when you're in Texas, you don't need to bury and insulate all of your pipes, because when you're moving water in a very, very cold area, freezing is a very bad thing. It's the equivalent of nighttime for solar. And the second thing is the header houses need these foundations and concrete. They're like little mini. They're called header houses, but they're mini little houses. And when you move these header houses, the reclamation costs, you're looking. This is radioactive material now that you can't just smash down and dump at your local dump site. So they're higher costs. Whereas I prefer Texas because you don't have header houses. You hook up your mobile header house to a truck and slide it over to the next production zone, and all your pipes are on the ground because it's warm and nothing will freeze. Nothing needs to be buried. Nothing needs to be insulated. And all these, and when it comes to reclamation, there is no reclamation because the header houses are mobile. So these are the little costs, as you go and do site visits and you figure out all of these aspects. Where I will not put any money is any European uranium projects, and believe it or not, there were many, many, many in the last cycle, and they will come back. I will not play around with any, deep in the money or what they call leverage plays in non-producing areas in Africa. And also the social and political aspects in certain regions where there is uranium has significantly changed for the worse from the last cycle. So just because a previous uranium explorer developer spent $40 million drilling out this asset, but uranium crashed and now it's $60 or $70, they can make it fly. You have to go, okay, the uranium hasn't moved or changed, but what has changed about the political aspects? So I guess I sound like a negative nanny here, but what I'm trying to say is I've been here and done it for over 15 years in the uranium sector. I've pretty much seen it all in the game. And what you want to expose yourself to is cash flow and royalty, because you will trade at a premium to NAV, meaning you will get more for your investment than the developers or producers. You want exposure to the exploration success and the production, but don't forget about the royalties. They're unsexy, but they're very profitable.
Marin, I've got a few questions for you, and thank you for that detailed explanation of how you're approaching the uranium sector. Kind of my first question is, you're approaching this from a fund manager perspective. You manage hundreds of millions of dollars, and any fund can only invest in so many deals without losing kind of control of what's being invested in. That's maybe a bit different than audience members who might be investing a $100,000 portfolio or $1 million portfolio. And they might be saying, well, Marin, why don't I just invest in quite a few of these uranium deals simply because they went up last time and they will go up again?
So what I have found, Colin, when I first started out, that was the original. I guess my audience, my subscribers have the benefit of me talking about my own mistakes, and I have made probably more mistakes in the game than anyone around. I've made lots, and I'll probably continue to make many. But I'm the largest shareholder of my own fund, so this is my money, and that's one key factor. So if I will advise that if you ever invest in someone's fund or company, make sure that they are more invested than yourself. So why I won't play, a basket of 40 companies, it doesn't work, Colin. Here's the reality. If you look at it throughout history in the last cycle and the cycle before that, and I've done this deep analysis and I've published it, you only need to pick 4 or 5 at tops to get the true beta or the absolute alpha of the performance of the sector. Because, so many Johnny-come-latelys are going to come, but they're going to structure the paper where they get the cheap paper, and the retail crowd is going to get, their paper in the market. So avoid that. Look for management teams who've been doing this for more than just a couple of years. You want guys who've spent the whole bear market in the sector, because if they've been there during the pain, the majorly painful years, like as bad as it's been for copper or gold or silver, or any of the other metals, trust me, it's been way worse in uranium. And if you can find a management team who's been able to survive during the absolute bear market, and there's maybe 15 to 20 who are there during the bad years, and of that, you need to focus on maybe 5 or 10, your research is a lot easier than it is during a bull market when you're going to have hundreds of uranium companies. So all you got to do is focus on the bear market years, because during the bear market years, the guys who survived were able to pick up the best assets at virtually very low cost or structure the most accretive deals at a bear market because the owners of these assets had so few options. Hence, when you fast forward to the bull market, the best stocks will be able to attract the biggest money. And when the big money comes in, so when the big fund managers and the passive ETFs start flowing into the sector, they're not going to go to these Johnny-come-latelys. They hire very smart people that are going to do exactly what I've just done, but it's going to be in a couple of years, and they're going to evaluate the same stocks that I'm talking about now. And that's just the way it goes. So why be positioned into some future uranium deal where they're going to get some moose pasture, they're going to pay some crazy marketing fees? You don't need to be exposed to that. Now, granted, Colin, I'll probably miss a few 10 baggers in that sector, but I don't care. I'm about mitigating my risk and trying to make a fair return on my money. And I still think I'll make anywhere between 3 and 8 times my money on the positions that I'm in with very low downside risk. And that's the key to succeeding in the resource sector. It's not your upside, it's mitigating your downside. That has been the absolute key to my success.
That's an excellent point. Marin, before we hit record, I shared with you a story of getting picked up by my dad in 2002 and him saying that he had just bought a past producing uranium mine. And that ended up getting the benefit of the uranium bull market and eventually being taken out by Uranium Energy Corp. But what we saw from 2002 to 2007 was maybe a handful of public uranium companies swelling up to 3, 4, 500 of them. And now it's certainly come back down closer to the handful number. When you compare now to how bad things were before the last bull market, what do you see?
Well, here's the interesting thing. I've seen a lot of the guys that I've done site visits with, financings with. When I was one of the younger guys in the industry, I was at the benefit of, I made my first big score in tungsten, and then in 03, 04, I rolled into uranium, and serendipitously, it just worked out incredibly well. But all of the guys who are the movers and shakers of that generation of the early 2000s, I've seen many of them pass away. As you know, a mutual friend of ours passed away a few months ago, and he was a mover and shaker in the U.S. Uranium sector, and it's sad to see that. But what I'm getting at is the baby boomers are aging and retiring and passing away, and there's very, very few next generation who's going to take over from the boomers from the sector, and that's been the biggest gap I've noticed, Colin, and very cognizant during my research, because so many of these guys who spent their whole life in uranium, I got to know so well in the early 2000s, and they were kind of old back then. And there's just a few management teams who are in their 40s and 50s that have the experience, the know-how, the street skills, the financial skills, the social skills to succeed in the sector for uranium, because there was no money in it for 10 years. So many of those candidates who could have succeeded in the sector, they went to real estate or the marijuana sector or the tech sector or Silicon Valley or blockchain or whatever. And it's kind of made our job a lot easier if you know what you're doing. And when the next bull market comes, people are going to be scrambling for assets, but you kind of want to just be positioned with the guys who've toughed it out during the painful years.
Excellent. Marin, you've been talking a lot about royalties, getting exposure to the cash flowing side of the business. I think that a lot of people are probably listening, wondering how do they actually do that? And without being a paid member of your research, I mean, what kind of avenues are actually out there for people to get that kind of exposure in such a niche space as uranium?
So here's the beauty of it all. There, there's so few ways to get exposure to it, and that's what I love. In 3 or 4 or 5 years, there's going to be many, many uranium companies going to it. But when you're the first guy, when you're going to be the Franco Nevada or the Silver Wheaton of the uranium sector, 5 or 6 years later, there's now 50 royalty and streaming companies, both public and private, looking to get the assets. But all the best assets have already been picked up and structured deals with. So there is no way to really play it right now publicly. There's only one private uranium royalty company in the world. It's an interesting hybrid. It owns shares of Yellowcake, which is a UK listed company that it owns about around 10% of its holdings, and it's already up, almost 30% on that position. They put over $20 million into that. It's private. It'll be doing an IPO sometime in the next 12 months. It could be in a few months. It could be in a Q1, Q2 of 2019. I don't know. I'm not part of management. I'm just one of the largest investors in the deal at the same price as my subscribers. So that's what I try to do, Colin, for my newsletter. I say, hey, when I started out in the industry, I looked at guys like Rick Rule and Doug Casey, these guys who've made hundreds of millions of dollars back then in this sector, and they're standing there talking about, private placements and warrants and, how to play this game. And I'm going, in the CFA textbook, they don't even talk about warrants or private placements. They don't even talk about the resource sector. So through, hard work, and I became partners with both Rick and Doug, and then I started managing all of Doug's money and done very well for him. And I realized that, what, after you go through a few cycles and you get more leverage with companies, and I call it, the Katusa Army, where now my subscribers come in, the accredited subscribers, for all the regulators listening, only the accredited investors can participate with me at the same time, at the same price, and no fees are paid. There's no finder's fees. 100% of the money goes to the company. And it's this advantage that I've created, and the companies prefer that because they're not paying. A lot of people don't realize it, but when they get a broker in, for every $1 invested through the brokerages, only 85 cents gets to the company. 15 cents goes to the brokers. It's crazy. So I said, let's get rid of the middleman. Let's just go straight to the companies. So that's what we did. So my subscribers are in at the same price in the pre-IPO. And Colin, what you're going to see next is some big money out of New York and Silicon Valley who are very bullish nuclear for all of the reasons that, Mike has talked about on your part 1, part 2, and for all the reasons that I've said. Interestingly enough, I've had many SPVs, so special purpose vehicles, contact me going, hey, do you want to be on our board? Do you want to invest with us? How do we work together? And I said, guys, I do my own thing. I manage my own money. And interestingly enough, all of them loved my short case. Every single one of these groups who have a lot of money always talk about, how do I protect my downside? So I guess the answer I'm trying to really emphasize to your viewers is the upside will take care of itself. But, this uranium sector, I don't know if uranium is going to get to $50 in the end of 2019 or early 2020, or will it do a pullback? All I can focus on is mitigating my downside risk, investing with the absolute best people in politically stable jurisdictions, and have the maximum upside through either cash flow or discovery. So that's where I position myself, and I hope your viewers take a different view of how to invest. And the last point, Colin, never, when you talk about, someone with $100,000 or $1 million to invest, the biggest mistake I've seen through, writing and doing what I've done for the last 16, 17 years is an investor gets all excited and they've got $50,000 or $100,000 and they buy all their stocks in like the same day. Never, ever, ever do that. I don't do that with my fund, and it doesn't matter if I've got $100 million of cash or $5 million of cash. You don't buy all of your allocation at once. Buy in tranches. It's something that I've been monthly preaching to my subscribers, and you ease into the positions. And so many people get excited They subscribe to whatever newsletter, whether it's me or Doug or Dines or whoever, and Mr. Dines. And Mr. Dines is a good friend. And what I'm trying to get at is they read it and they get all excited and they want to buy their whole position tomorrow. Don't do that. This is a marathon. If you're speculating or playing the resource sector, think of yourself as doing an Ironman, not a sprint. And if you want to succeed, you've got to have the Ironman mentality, not a sprinter's mentality. And mitigating risk, buying in tranches, sticking with the best people, staying away from crazy, look, there's some great uranium deposits that are in Al-Qaeda regions where they're training, people who want to kill you. And I know geologists who have died in these areas. I don't care how much money I could potentially make there. It's not worth the risk. So why bother when I could, hop on a plane to the Athabasca Basin, go on a site visit and be back in the same day, or do the, Texas, spend a night there, then risk my life or, the management team or the job. It's just not worth it. So think those steps through, and the upside will take care of itself if you mitigate your downside.
Marin, let's end with your best guess at reality. You started with the bear case, but that's not because you're bearish. Of course, it's a tool that you use to actually convince yourself that you're in fact potentially more bullish than you might have thought to begin with on uranium. What do you think the outlook is for the next few years? Looking at how many reactors are going to come online, how many are going to go offline, what kind of price is needed for things to get incentivized properly?
Okay. So for the rest of 2018, I believe the overall resource markets, just like I've been writing since, January, I've had some pretty good calls here. We've had many buyouts. I believe we're going to continue to have a few more buyouts. But I don't see uranium popping anytime soon, meaning till the end of the year. So we got 3 more months of, up 25 cents to $1, down 35 cents, kind of going sideways. Where I think things will get interesting is the speculation towards Section 232. But remember, this is governments. I'd be shocked, and I've never seen a government do anything on time or on budget, okay? So that angle of it will take longer. What is interesting is what the elephant in the room, the Kazakhs, people forget that they are 40% of the primary uranium production in the world. That's the equivalent in the oil markets of taking all of the 12 OPEC nations, or 13 now, and adding Russia to that. So it's like taking OPEC and Russia in the oil sector. That's what Kazakhstan is itself in uranium. And follow what they're doing. And they're being very, very strategic, and they are so smart. There's some sort of Western bias in our media. If you're going to be a serious uranium investor, you need to start visiting these sites or follow someone who knows these people and has done these site visits. Kazakhstan is a serious player. They are very smart, and they are positioning themselves. So I think you're going to see middle of 2019 towards the end of 2020 when the uranium markets are going to really start hitting it. So by the end of 2019, I see us touching, 35 to 40. And then 2020, I really see us getting above 40, 45 to 50. It's going to take a while, and it's not going to be an overnight, quadrupling and tripling of a market. But remember, it takes so few black swans to come in and focus on what Cameco is doing. Cameco shut down McArthur River, which is the second largest producer in the world, and that is ultra high grade because even they could not make any money under $30 uranium. They just couldn't do it. Even with their hedges, they said, this is stupid. We'd rather go into the market and buy up and with the Japanese reactors coming on. And one thing I want to address in my short report that I remember, it's kind of a fake short report. It's not like I'm short uranium. I'm one of the largest investors in the sector. But Colin, I didn't even include any of the Japanese reactors coming online. Like think about that for a second. My numbers, I said, let's just say none of the Japanese reactors come online. That is massive. Okay. You know that there's going to be about 20 to 30 coming on in the next 36 months just in Japan alone. They have to. They are investing billions of dollars globally to diversify from their electric needs. So they're trying to build LNG plants. They've come and they've passed the bills to bring the reactors back online. Now, again, it's government. It's going to take longer. Most people expected it to be online by now. Governments take their time because they have to. It's a bureaucracy, and they have to deal with the public. And in my numbers, when you start adding in the Japanese numbers, we can get to $60 uranium very quickly. But like I said, the upside takes care of itself. Focus on mitigating your risk.
Is it possible, even if it's just a small possibility, and don't worry, I won't title the interview uranium to hit all-time highs, but is it possible that uranium at some point in this bull market could spike above that ridiculous number of 160 we saw last time?
Well, the last number I saw, that the highest that I saw traded was 138 a pound US, so maybe it was 160 Canadian or Australian. But could I see that in this cycle? You'd never know what would have to happen. Remember, so few mines produce so much. So if you look at Cigar Lake, when I was up there last February, I have a whole videotape of what we're at the mill and McLean Lake, and visiting these projects. What really was the catalyst in 2006 was the flooding of Cigar Lake. If one mine, it's not like copper or gold. There's 670 or just under 700 gold mines that produce over 100,000 ounces a year. There's a handful of uranium mines that bring the serious production in. If anything happens to those, then yes, definitely, Colin, we could easily see the previous highs be broken. But if production goes as expected, I don't see us hitting those highs. Why did we hit those highs? For two reasons. People realized how risky uranium production is because of what happened with Cigar Lake. McLean Lake shut down, and it didn't really move the markets that much anywhere near 2006. But it was the outside money coming into the sector and buying up pounds in the ground. We're starting to see that again. And I've been approached by two SPVs that are looking at buying pounds in the ground. Pounds like what Yellow Cake just did, or Uranium Participation Corp did in 2006, 7, and 8. There's going to be more of that. And the Kazakhs are bearish. Kazatomprom is now much more familiar with the private equity markets and the whole global markets than they were a decade ago. Remember, they've only been a producer at this level for almost 18 years. 20 years ago, they were not a dominant producer. This is all in the last 15 years that they've gone from zero to hero, and they're going to maintain that position. Do not bet against the Kazakhs. And the other elephant in the room that nobody talks about, and I have a whole chapter in my book, is do not underestimate the Russians here. They have almost half of the world's enrichment capacity. And when the rest of the world turned their back on uranium, the Russians kept moving forward with this. So do not underestimate the Russians either. So unless the black swan event happens, do I see it breaching? No. But can it? Definitely. And remember, mines are so tough, Colin. I've been to hundreds of them. You've been to many of them. Anything and everything that can go wrong at a mine or a mining operation usually does. It's not fun. It's not like going to Google, everyone's happy. And, mining is a tough, tough business. So expect the unexpected, especially in the mining sector.
Well, Marin, for resource investors, or at least speaking for myself, the idea of a slow and steady rise up in a commodity seems like a great way to make some money. We've had the kind of beginnings of a exciting bull market back in 2016, but I think for at least traders, they might have lost more money than they made with that bump up and the bump down. So it's good to see what's coming. Thank you for sharing all this information, and hopefully we can get you back soon. I know you don't do these interviews very often, so I do appreciate it.
Yeah, you know what? I actually pulled away just focusing on my own business. And when I saw it was you, I went, geez, I haven't done an interview with you in like 2.5 or 3 years. So I thought it'd be fun. Plus, we have. I really enjoyed watching the growth of you and CJ, and CJ worked with me for 5-6 years. Such a great guy. So love seeing you succeed.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?